Well, good evening, everybody. There's been a fiery debate between growth investors, people that like to buy stocks that are growing rapidly and have bright futures, and people that love dividend income, or as they like to call it, passive income. It's a huge debate swirling around YouTube and around X and around the world. And I'm here to settle that debate for you, specifically with two very popular ETFs, QQQ and JEPQ. What are these two ETFs? Let's dive right into it. So QQQ is an ETF that is called the Invesco QQQ Trust. This ETF is based on the Nasdaq 100 index. The Nasdaq is a digital exchange in the United States, and it attracts a lot of exciting growth stocks and tech stocks, okay? So when you look at the Nasdaq, you're going to see Apple, Microsoft, blah, 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 all the big companies in the United States, okay? What QQQ does is they take the largest 100 non-financial companies on the Nasdaq, and then they invested them at market capitalization weights. So the bigger companies are more represented in the index. So basically, you're investing in the top 100 stocks that are not financial stocks that are on one specific exchange listed in one country, the United States. Do I agree with that? Personally, I don't. Okay, but that's your decision. So this is kind of like a tech ETF. You want large cap tech, bro? You want to be exposed to large cap tech? This is the way to go. This ETF is insanely popular because it has had fantastic returns. The US stock market has been significantly helped by the large tech companies, Apple, Microsoft, Meta, Tesla, et cetera, NVIDIA. All of those companies have had astronomical returns over the past decade and a half. And they have become huge percentages of the entire market capitalization of the US stock market and the world. So what people do is they say, well, the best companies are in the United States. The best companies are the largest companies because they're tech companies, and QQQ owns all of those companies. And if I look at the past performance, these companies have done fantastically well. QQQ has crushed the S&P 500. If you had bought QQQ and only invested in that since 2009 or whatever, you would have made you would be insanely wealthy. You would have crushed everybody, basically. Okay? So it's a very popular ETF. What's the problem with it? What's the big issue? Well, there's multiple issues in my opinion, but specifically for this video, it's the yield, bro. So there's some investors out there that they have to have dividend income. They don't feel like they're making money unless they're getting a check in the mail. They like to see their ETF drop by the amount of the dividend and use that income to either reinvest, also paying taxes, or to distribute and take out for their own personal needs. Whatever makes you happy. But QQQ, despite having astronomical total returns, is not popular with the dividend crowd because it doesn't pay a large dividend. The 30-day SEC yield, that's an annualized yield basically, is 0.54%. So if you just wanted to live off dividends, you wouldn't be able to do that with QQQ. Because God help you if you sell some shares. Oh my God. Okay. You can't, you'd have to have millions and millions and millions of dollars in QQQ just to be able to live off the dividend and the dividend alone. Okay. Now, of course, the dividend is a tiny component of this fund's total returns. So you look at the 10-year return, the 10-year NAV return, 18.28% compounded. That's crazy. That's a very, 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 very good return. Okay. Insane. This has crushed the S&P 500, everything. But it doesn't have the dividend. But if you want a dividend, if you want exposure to these exciting tech companies, well, there's an option out there for you. It's called JEPQ. Okay, so let's go check out JEPQ. This is the JPMorgan Nasdaq Equity Premium Income ETF. So what do? They generate income through a combination of selling options and investing in large cap growth stocks in the United States, seeking to deliver a monthly income stream from associated options premiums and stock dividends. It's probably mostly from the options, okay? It seeks to deliver a significant portion of the returns associated with the Nasdaq 100, which we just talked about, QQQ. And it constructs a long equity portfolio through a proprietary data science-driven investment approach designed to drive portfolio allocations while maximizing risk-adjusted returns, blah, 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 blah. Why is this ETF popular? Well, it's got a pretty high SEC yield. So remember we looked and we saw that QQQ only had like a 0.54% yield. This one, their 30-day yield for this JEPQ ETF, which has exposure to large cap tech, bro, is 11.43%, which is an insane yield if you think about it. Okay, that's like, I wish I could invest in something that just spit out 11% per year. I'd be retired already. So a lot of dividend investors like this because it has a high yield. It pays monthly income, and you don't have to worry about selling shares. God help you. But you can still get a check every single month. That's why people like it. But is this really the ideal way to invest? Well, let's talk about covered call ETFs, because that's basically what this is. So I use Google AI, which is so amazing, but it's a good summary. So let's talk about this. Covered call ETFs, which generate income by selling call options on their underlying holdings. So you take a call, it's a contract, a buyer and a seller. If you're selling a contract, you're receiving a premium, but you give up certain rights. And the right is you may potentially have somebody buy the underlying shares of the ETF or stock from you at the strike price. You get a premium. That's your compensation for the risk of having your shares taken away from you. That's how you generate the income, okay? Tend to underperform in strong bull markets, but can provide a buffer during bear markets when the market falls due to income from call premiums. So if you believe, and this is what people do, okay? They look up the performance of the U.S. stock market, and they see it's basically 45-degree angle for all time. If you believe in the bullishness of QQQ and you believe that the U.S. is exceptional, we're going to have a strong bull market going forward, and AI is going to change the world, a covered call ETF like JEPQ is going to underperform. The only time it's probably going to do better is during a bear market because the stocks are falling, right? The underlying stocks are falling, but they're selling call options, so they're generating income. Whereas there's no call options being sold on QQQ. So they're still getting that option premium coming in. But in a bull market, when stocks are vertical lines, bro, guess what happens? You underperform because you miss out on a lot of the capital gains from the underlying stocks, okay? So you get all the downside with a little bit of buffer from options premiums, and you get limited upside. So you're getting an 11% yield, but your total return is not doing as well. Okay. So you can read more about it, but basically, in a strong bull market, covered call ETFs are not going to do that well. So if we compare the ETFs a little bit more, and then we're going to look at their total return, because in my opinion, that's all that matters. So if we compare JEPQ to QQQ, obviously there's a lot more interest in QQQ. $304 billion are invested in QQQ as opposed to $23 billion for JEPQ. A lot less popular. There's also a lot more volume, a lot more trading of QQQ. They both have roughly the same amount of holdings. And of course, we see the expense ratios differ. So the expense ratio for JEPQ is 0.35%, which is a drag on your returns. You want expenses as low as possible. Whereas QQQ is 0.20%. So that's a 15 basis point difference right there, which in the long run, over many, many years, will significantly drag your returns down, okay? But that's not all. Let's go look at the total returns. If you pull up a stock chart, and you look at that chart and you think that's how much the investment made, you're clueless, okay? Because some investments pay out higher dividends. When a dividend is declared, when it's declared, basically, the stock price of the underlying investment drops by the amount of the dividend because it's a distribution of capital to you. You're getting paid out cash from the company or the ETF. So therefore, the value of the underlying holding drops by the amount of the dividend. Okay. So if you have a company that pays a 10% dividend per year, and you have a company that pays a 0% dividend, well, assuming they're roughly the same company, the one that pays the dividend is going to have a lot lower stock price appreciation than the company that doesn't pay a dividend. But when you look at the chart, you're not going to see that. You're just, oh, well, this one company sucks because it's not going up a lot. It's got a high dividend yield. They're paying out a lot of cash. It's dropping the stock price. Okay. Total return. So the best website, if you really want to understand the past performance of an investment, which I personally think is irrelevant in the long run, you go to totalrealreturns.com and you can look at it from real perspective, inflation adjusted, or we'll just look at it in nominal dollars. That's not adjusted for inflation. So if we look at total returns, okay, what has done better year to date? JEPQ. Why? We've been in like a almost correction type territory. The stock market's sold off because tariffs, drama, whatever. JEPQ has a total return of negative 6.58%. So it seems to make sense, right? QQQ has a negative total return for the current year to date, of negative 8.14%. Okay, that's just year to date, so a couple months, who cares? But if we go back since the inception of JEPQ, okay, so the blue line is QQQ and the red line is JEPQ. The red line with JEPQ assumes that you're reinvesting the dividends. If you're not reinvesting the dividends, and we can go change it afterwards, that line ain't going to look too hot, okay? And if you go down and look at the total returns, ever since the inception of JEPQ is a lot newer than QQQ. QQQ has had an overall return of 45%, as opposed to 38% for JEPQ. So at the expense of you get a little dividend every month, makes you feel good, makes you feel all warm and fuzzy inside. But you actually gave up total returns when you could have just sold some shares of QQQ. Oh my God. So if you sell a share of QQQ, oh my God, you own fewer shares. But guess what? The price per share has gone up. Okay? So who freaking cares? But anyway, and your ending portfolio your ending portfolio value since inception, if you had just bought QQQ, would be $14,520 as opposed to $13,851. Not to mention the taxes. Okay, there's also tax implications. So we can look at the performance by year. So in 2022, we had a bear market. Let's zoom in a little bit. What happened? During the bear market, QQQ fell a lot more because it didn't have that options premium to offset it. And possibly JEPQ might have been launched a little bit in that year. So maybe that has something to do with it. But then look at the recovery. So you wanted your income, right? In 2023, QQQ returned a total return of 54%. That's pretty strong. As opposed to 36% for JEPQ. So that's a differential of almost 20% returns during a strong rally. And then you look at 2024, still a slight variance, but QQQ still outperformed. So we had 2 good years, and over those 2 good years, you had a massive differential between QQQ and JEPQ. So it's only going to give you some buffer in a bear market, okay, or in a choppy market. It may give you better returns in a choppy flat market or a bear market. But if you believe in the companies, large cap tech bro, why don't you just own the underlying ETF? You'll probably have more money at the end of the day, not guaranteed. Your total return will be higher and you can sell shares as needed. Okay? Now let's see if we can turn off the reinvested dividends. Because I guess it doesn't come off here. But if you go look at the chart of JEPQ without reinvested dividends. Let's see, JEPQ ETF. The chart doesn't look that hot if this actually loads. Because, you want to know why? Because the stock price, the ETF price, is dropping by the amount of the dividend. And if you're taking all the money out, guess what? Well, it's not popping up. if you're taking the money out, you're going to be surprised that the total capital appreciation hasn't been that impressive, okay? When you should have just kept it in the freaking fund. So what do you guys think? What's the superior one? JEPQ, because it's got a dividend, pays you income every month, bro, for a higher expense ratio and lagging performance in a bull market? Or would you rather just focus on total returns? This is just an example. It's just an example. Okay? Let me know your thoughts. Let's do some comments. Let's see what's going on here. Book a free 30-minute tax consultation. I am a certified public accountant. I will do your business and or personal taxes any state in the United States. You can talk to me for free. I give you upfront quotes, and I'll prepare your taxes like a boss. Tax season's almost over. You better get it done. Wow. Guy is attacking by emergency funds. Damn right, boy. I have mine in Misty. Strongman is having yet another meltdown. Well, yeah, if you hang around long enough, trust me, I'll take a dump on Misty again. Let's see. Wrong. Oh, now we're in Berkshire. Okay, now we're in Berkshire, Gil. First it was clown stocks. Now it's QQQ. Now we're in Berkshire. Let's see. Why waste your time on QQQ, but you can just buy SGovy? Income is key. Yeah, levered treasuries. What could go wrong there? The interest expense is definitely lower than the yield. TQQ. Oh, that's beautiful. Guys, growth stocks are the answer. The masses are never wrong. Index funds always go up because everybody buys stocks at any price with passive index funds. Yeah, that's why stocks collapse all the time, because index fund bubble, bro. When you buy index funds, you are going against the herd by buying what everybody else is buying. You are truly a contrarian. I love your comments. VTI and VXUS do 20%. Why 20%? It's just a random percentage. What? Just do 15, do 10%, do 5%. You're just making up numbers. Market cap weighting. It is diversified. It's about as diversified as you can get unless you add bonds. JEPQ dividends are not qualified. Even better, so you're paying tax. Your tax drag is way worse. QQQ is actually way more tax efficient on top of that. Sell shares. One day you might actually need the money, okay? And if I knew two investments were going to have, if I knew an investment paid a dividend monthly, but I knew the other one had a better total return, I would go with the one that had a better total return every freaking time. And I would just sell shares as needed. Covered call ETFs are for when you really think the market is just going to move sideways. If it's going down, you're better off in cash. Yeah, and that gets back to market timing. Like, do you really want to do that? Let's see. Your emergency funds in Bitcoin. I'm sure nothing will go wrong there. Well, yeah, it's the end of tax season. It's almost done. I'm getting straggler clients in. I just got a straggler client today. And I wouldn't be surprised if a couple more clients pop up on April 14th. Can you do my taxes, strong man? Can you have them done by tonight? Yeah, I'll extend you and I'll do them in the next couple of weeks. But yes, tax season is basically over. Pretty good year. Okay. Anyway, that's it for tonight. What do you think? Like, subscribe, book a free tax consultation. Even if you want to extend, people, you realize that if you owe tax, you still have to pay it by April 15th. You know that, right? You can extend all you want. That doesn't extend the time to pay your taxes. So if you're going to do an extension and you need help with your taxes, you got to pay it, and you might need to use a CPA to help you calculate how much tax you owe so you don't get penalized. Okay, I'm just putting that out there. Just putting that out there, okay? Book a free tax consultation. Have a wonderful night. Cheers.